Okay, so I've got a question on Chapter 11 homework. And this isn't the exact problem that we do in Chapter 11, but it's a really similar one from the back of the chapter. It's exercise 11:18, but it looks very similar to the homework problem. So I was going to do it here for you, and then you can follow along, and that should help. So it's got three parts. The first part is a series of journal entries. The second part is creating a statement of retained earnings. And the third part is creating the stockholders' equity section of the balance sheet. So I have an Excel sheet open here in case we need it. And let's get started. So the first thing that gives us is the statement of, or parts of the stockholders' equity from the previous year. So we can see that they've got common stock on the statement of stockholders' equity. And it's $25 par value. They've authorized 5,000 shares to be sold, but they haven't sold them all. They've only sold 30,000. They sold them all and they're outstanding. So this value here is $25 per share times 30,000 shares. That's $750,000. And then, because they sold them for more than par value, they have this other bit here, paid in capital in excess of par value common stock, $50,000. And then they have a previous balance of retained earnings of $340,000, which means that the stockholders lay claim to $1,140,000 of the company's assets, at least on paper they do. So in the year 2016, there are these transactions that relate to stockholder equity, and we're going to journalize them. So the first one is that they purchased $3,000 of their own stock at $25 per share. And so this bit here from January 2nd, it's purchasing treasury stock, and the section of that can be found in the text on page 498. But what we do here is we debit this account that's called treasury stock common. And so if we're purchasing 3,000 shares for $25 per share, we can do the math on that as 3,000 times 25. And that's equal to $75,000. And since we're selling these shares, since we're purchasing these shares in the market, we're going to pay for them with cash. So that's going to be $75,000 also. We're going to record that entry. The second one is declaring a cash dividend of $1.50 per share. So when we are paying dividends, there's two steps. There's the declaration of the dividend and the paying of the dividend. And descriptions for both of those can be found on page 489. So when we're declaring a dividend, the first thing we do is debit retained earnings. The reason for that is that when a company earns net income, they either retain it as retained earnings or they pay it out as dividends. And when we clear the net income account, we post it all to retained earnings. So when we declare dividends, we need to take them out of retained earnings. And the math for this is $1.50 dividends, $1.50 per share of dividends multiplied by the number of dividends that we have outstanding. And you may be tempted to say that it's this 30,000 shares that were outstanding at the beginning, but we've just purchased 3,000 shares. So at this point, we can just have this little section that we can call shares of stock outstanding. So at the beginning balance, the beginning of the year, or whatever this is, there were 30,000. And then on January 2nd, we repurchased some. We repurchased 3,000, which means that the balance at this point is just the difference between those two. So when we're declaring this first dividend, what we're dealing with isn't all 30,000 shares of stock. What it is this 27,000 shares of stock. So we're going to have to do 27,000 multiplied by $1.50, and that tells us that we're going to have to debit retained earnings of 40,000 by the amount of $40,500. And then to balance that, we're going to look at dividends payable. Common dividend payable, because we haven't paid them yet. It becomes a liability, something we're going to have to pay in the future. All right, let's record that one. So after we declare the dividend, we actually pay the dividend. You can also find a description of paying those cash dividends on page $489. But all we're going to do here now, we had created that liability, common dividend payable. But now we're going to debit it to decrease the amount by the amount of the dividend. So we no longer owe $40,000 in dividends, right? Because we're paying them off with cash. So now we have $40,500 less of cash, and we no longer have this money that's owed to shareholders. So let's record this one. So in the next one, we reissue 1,200 shares of that treasury stock that we just repurchased. So on January 2nd, we repurchased 3,000 shares of stock. And then now, here we go, on July 9th, we're going to sell some of those. So let's just keep track of how many we have outstanding. We're going to call that a July 9th reissue. And we're reissuing 1,200 shares of stock. So we've got this balance. Now we have 28,000 shares of stock outstanding. It's just nice to keep track of that number. Oh my gosh, can you hear my angry cats in the background? I've got 2 cats and they're brothers and sisters. And she doesn't like her brother. She's nasty. She's a nasty kitty. So we reissued shares for $30 cash per share. That means we bring in $36,000. So when we bring in cash, something for cash, we're going to debit cash. And then we'll need to credit our common stock. I'm sorry, our treasury stock common. But the tricky bit is that we're selling these shares for more than we paid for them when we repurchased them. So the amount that's in the treasury stock account is just going to be equal to $1,200 times $25, which is going to be $30,000. We can just do the math to reinforce that. 25 times 1,200, $30,000. So we can credit treasury stock only in the amount that we actually paid for those shares when we repurchase them. So what we have to do now is create a paid-in capital account, just like we would do with common stock, paid-in capital in excess of par. We'll have paid-in capital of excess of par treasury stock, or paid-in capital treasury stock. And we'll credit that $6,000, and that will allow this transaction to balance. Okay. Then on August 27th, we're going to sell more of these treasury shares at an amount lower than our par value. So on the example for July 9th, we were reissuing treasury stock above the cost. And then now we're going to be reissuing treasury stock under cost. So what we have to do here, similar to when we issue it above cost, we bring in some money, right? we bring in cash. And the amount of cash that we bring in, again, is going to be equal to the number of shares that we sell multiplied by the amount we get per share. So 1,500 times $20. So we're going to bring in $30,000. It's going to change the number of shares that we currently have. So let's just enter this again. August 27th, reissue. We're reissuing 1,500 shares. And so now we have a balance of 29,700 shares outstanding. We're going to need that number later. So when we're dealing with selling treasury shares below cost, I like to take it in 3 steps basically. I start by identifying the cash amount, which we did. And then I try to identify the value of the treasury stock that we sold. So we repurchased it at $25 per share. And we just sold 1,500 shares. So the value of that stock is going to be equal to the $25 that we paid multiplied by that $1,500. So we just sold an asset that is on the books at $37,500. We just sold it for $30,000. So we're going to have to have some other debits here that allow us to balance the money we receive, which is less than the money we spent to buy that asset. So we can hold on to this number in our heads for a minute because we need to figure out what we do to balance those two amounts. And in this case, we have our paid-in capital. Let's see, I'll record this temporarily. Yep. Here we had paid-in capital of $6,000. The rule with treasury stock is that we can't have a negative paid-in capital. So we can't jump over here and just say, oh, well, now I'll take $7,500 out of paid-in capital, because then that would be a negative amount. So we had $6,000 in paid-in capital. We're going to start by depleting that. And when you've depleted all of that, then you take the rest of the difference out of retained earnings. And that will balance with the book value of that treasury stock that we sold. So we've got our debits equaling our credits. We reissued treasury stock for $20 per share, which allowed us to bring in $30,000 in cash. That was less than the book value of that treasury stock, which was $37,500. So to make our debits and credits balance, we had to debit treasury stock for $6,000 to remove that paid-in capital that we had generated in our previous transaction. And then because that still wasn't enough to make up for the shortfall, we had to take $1,500 out of retained earnings. So now we're going to declare a cash dividend of $2 per share. That's why I was holding on to this balance of the number of shares we have outstanding. So we're going to declare dividends, and to do that, we debit retained earnings. But what we need to do is pay dividends $2 per share on each of those 29,700 shares. And so that's going to be $59,400. And it's not cash because we haven't paid it, right? It's common dividend payable. So we've declared it, and now we owe a dividend on common stock. So common refers to common stock, dividend is dividend, and payable means it's an obligation to pay because we've declared it. And then after we declare it, now we have to pay it. So we're going to basically pay off our liability of common dividends payable. We're no longer going to owe that. Let's just subtract $59,400 from that balance and through that debit. And then we will take cash out of the bank and we will pay that cash to our shareholders, and we record that with a credit to cash. So lastly, we're closing out the income summary to the retained earnings account. So there was a credit balance of $52,000 in the income summary account. Great. If we want to close a credit balance, we debit it. I like it when the answer of exactly what to do is in the description. 52,000 retained earnings. Boom. Let's record that and check our work to make sure we're looking good. And so, yep, all good, but we're not done. We have 2 more bits, and it's actually the fast part. So rather than starting a new video, I'm just going to keep going. Bear with me. So now let's just prepare a statement of retained earnings. Statement of retained earnings are really quite straightforward. They start with the balance that we had last year. So that's just going to be the retained earnings balance previous year. We get that up here from this section of the stockholders' equity on the balance sheet. There was $340,000 in retained earnings. 340,000. And then when we're dealing with retained earnings, we're going to just add whatever our net income was. And in this case, our net income is here from the income summary, so $52,000. And the total updates automatically. And then the last 2 things that we need to deal with here that lets us know how much, the things that influence retained earnings are our dividends, because net income that goes to dividends, it doesn't go to retained earnings. So we're going to subtract, type in less dividends declared, and all in total, we declared dividends of $40,500 and $59,400. Total amount of dividends is $4,500 plus $59,400. It's going to be lots of 9s. 99900. So of that money that we could be adding to retained earnings, we're not adding all of it, because 99,000 of it gets paid to shareholders. And then we had to make this little adjustment to retained earnings because of our treasury stock. So we're going to subtract that also. Less treasury stock reissuances, common stock, $1,500, the amount that we had to debit retained earnings. So there we go. That's our statement of retained earnings. So the very last bit we have to do is figure out that section on the balance sheet that deals with retained earnings, and that deals with shareholders' equity. And that always follows a pretty straight pattern. We start with just the book value of the stock that we've issued, right? And that's this amount here, common stock. It doesn't change even though we've had the situation where we've bought and sold shares. We're just dealing with the historical bit. And for that matter, the paid-in capital in excess of par that we got when we sold the common stock the first time, that amount doesn't change either. We will need to make an adjustment to the retained earnings amount and we'll have to add a line for the treasury stock that we repurchased. So let's start with these things that didn't change. Common stock at $25 per share. That value up top, $750,000. The next thing that doesn't change is that paid-in capital in excess of par. It was $50,000. Where did I get that number? Up here. This other bit that doesn't change. Now retained earnings is going to change, right? That's going to change. That's why we did this statement of retained earnings, because we need this balance here now. That means overall, through the history of the company, of the net income they've earned, they've put back $290,600 of it. They've allowed it to stay invested in the company. But then this year, they repurchased some treasury stock. And to figure out how much of that, the number that needs to go in here, what we can look at is the number of shares that are still in treasury stock, right? And we purchased 3,000, we reissued 1,200, we reissued 1,500, so there's 300 left outstanding, right? Or that we actually, shares of treasury stock is just going to be equal to the amount that used to be outstanding minus the amount that's outstanding now, right? So 300 is what we own. And then the book value of that is just equal to the number of treasury stock shares that we own multiplied by the par value when they were first issued, because what we're trying to do is just adjust the book value. So then we have to just say less the cost of treasury stock, which is the number of shares of treasury stock that we own multiplied by the book value per share. And if you're wondering where in the world did that book value come from, it came from up here. Common stock, $25 par value. So our value of our treasury stock is the par value multiplied by the number of shares we have outstanding. So our total stockholders' equity is $1,083,100. And that is the solution to this problem. And I hope it helps you when you go to work your problem number 11. Let me know if you have any questions, and I will get back to you.